The market isn't as confusing as it may seem, and the economy isn't as unpredictable. What makes all of it feel that way is how people interpret it. And when you're looking at the entire system all at once, it can feel overwhelming. But when you start to break it down into smaller pieces, and more importantly, begin to recognize the patterns and how those pieces move together, that's where strategy begins. I'm Christiana Lovelace. I'm a licensed financial advisor and accredited asset management specialist, and I own Diamond Point Financial. Each week on Pointe Perspective, we step inside the analytical process behind financial decision making, breaking down how professional investors evaluate markets, interpret economic shifts, and build strategies designed to move within them. This week, we're not just talking about what's happening, we're focusing on how to think through it by looking at the patterns behind it. First, we'll walk through a natural rhythm of the market and what normal volatility actually looks like, and why disciplined investors often see opportunity where others may see risk. Second, we'll step back and look at the economy through a different lens, breaking down historical periods of contraction to understand what actually happens across GDP, jobs, and consumer sentiment. And third, we'll bring it all back to strategy, breaking down annuities and how they're commonly misunderstood and how to determine whether they truly belong inside your financial plan. Because financial success is about recognizing patterns and then building a structure around them. Most people think something is wrong with the market when it drops. Inexperienced investors often believe that up is the only acceptable direction. But the reality is these movements are completely normal. Sophisticated investors understand that when the tide goes out, it reveals what's been hiding beneath the surface. Sometimes it exposes risk, but it can also reveal opportunity. Historically, we can expect 3 to 5% pullbacks multiple times a year, a 10% correction about once every 12 to 18 months, and a 20% bear market every few years. These are not rare events, they are just part of how markets function. And in today's environment, with increased retail participation, these movements can feel even more amplified. The challenge is that many investors don't study the pattern, so they feel like they need to react to the moment. A 10% correction is where behavior usually starts to divide attitudes. For many investors, that's where fear sets in, but for disciplined investors, that's where attention increases. From their perspective, a correction doesn't represent loss, it's repricing, and repricing can create opportunity. Inside our office, we actively prepare for these moments. We maintain what we call a cash at correction list. These are clients who have already made the decision in advance. If the market pulls back to a certain level, typically around 10%, they're prepared to deploy additional capital. They are not reacting to the market. It is a plan that was already built and now it gets executed. Instead of asking what's wrong, they're asking where's the opportunity. That's where behavior becomes the differentiator. Some investors panic and pull back while others lean in strategically. Opportunities during corrections don't always look dramatic. Sometimes it's simply adding to long-term positions while valuations may be more attractive, or rebalancing portfolios across asset classes, or evaluating tax strategies that may present themselves. Too many investors react emotionally to volatility. They call when the market is down looking for reassurance, and those feelings are completely normal, but they can also cloud your judgment. The goal is to approach these moments differently, to move from reaction to preparation, because a lot of investors that I work with understand that these movements are part of the cycle. We focus on how to position them within it, not how to avoid it. And that shift in mindset can honestly make all the difference. Now, with all of that being said, not every market movement requires action. In many cases, the most disciplined decision is to stay exactly where you are. Because if your portfolio has been built intentionally, it should already account for this level of volatility. Reacting emotionally in the middle of a pullback is often what turns temporary movement into permanent damage. Fluctuations can feel uncomfortable, but it is also where opportunity can begin. And when you understand the rhythm of the market, you stop fearing those moments and you start preparing for them. When people hear the economy is slowing, their mind immediately goes to crisis. The financial crisis, the Great Depression, but historically, many economic contractions have been far more contained than that. They've been shorter, more targeted, and often driven by specific pressures, not systemic breakdown. And when you study them, you'll notice a consistent pattern across three areas that we've already discussed before: GDP, jobs, and consumer sentiment. Before we look at those periods, we need to understand what normal actually looks like, because you can't identify a shift if you don't know the baseline. For GDP, long-term growth typically falls in the range of about 2 to 3%, although what's considered strong or weak always depends on the environment we're in. The natural rate of unemployment is generally considered to be between 4 and 5%, with long-term average since 1948 being closer to 5.6%. And when it comes to consumer sentiment, a reading around 100 or higher typically reflects stronger confidence, while lower readings indicate more caution. But in practice, it's not above 100 as often, so it becomes less about the number itself and more about the direction of movement. Changes of 5 points or more over a short period of time can signal meaningful shifts in perception. Now, looking back at the early 60s, we see a short contraction that lasted less than a year. GDP declined modestly, not dramatically. Unemployment rose from around 5% to just under 7%, and consumer sentiment weakened, but it didn't collapse. This was largely driven by tighter monetary policy and inventory adjustments. The system slowed, but it held together. Now, look at the early 90s. This period was influenced by rising oil prices and geopolitical tension during the Gulf War. GDP dipped slightly into negative territory. Unemployment rose from about 5% to roughly 7.5%, and consumer sentiment dropped more noticeably as uncertainty increased. But again, we saw pressure, not collapse. In 2001, we had a different type of environment. The tech bubble had already begun to unwind, and then we experienced the shock of the September 11 attacks. GDP briefly contracted, unemployment rose from about 4% to 6%, and consumer sentiment fell sharply following the event. But what's important is that the damage was concentrated, it was not systemic, and the broader economy adjusted. And then we have an even more recent example. In 2015 and 16, parts of the economy slowed significantly, particularly in energy and manufacturing. GDP growth weakened, but it remained positive. Unemployment continued to improve, but consumer and business confidence softened, especially in those affected sectors. So here we saw a meaningful slowdown without even entering into an official recession. When you step back and look at these periods together, a pattern begins to emerge. GDP softens, the labor market weakens by about 2%, and consumer sentiment often shifts first and the fastest. But not every cycle turns into a crisis. Sometimes the economy just resets. And when you understand that, your perspective changes. You stop assuming that every slowdown is a collapse and you start recognizing where you are in the cycle. As we continue our discussion on protection planning this month, I want to talk about a topic that tends to create a lot of confusion in financial planning. Annuities are not inherently good or bad. They are financial tools, but like many tools, their effectiveness depends entirely on how they are used. And in my experience, this is an area where I often see a disconnect between the product and the overall financial plan. One of the reasons for that is how they're structured. Annuities can carry higher commissions and fees compared to other financial products. Anytime compensation is higher, it creates a potential for overuse or misalignment. Many financial institutions have placed increased focus on annuity products within their platforms, which can naturally lead to more frequent use. That doesn't mean every annuity recommendation is inappropriate, but it does mean these decisions require a higher level of scrutiny and planning. Before we go further, it's important to understand that not all annuities are the same. There are a few common types. Fixed annuities, which are designed to provide a set rate of return over a period of time. Indexed annuities, these are tied to a market index where returns are based on a formula linked to that index, often with limits on both upside and downside. And then variable annuities, where funds are invested in market-based sub-accounts with greater potential for both growth and risk. In order to offer a variable annuity, the agent must be properly licensed. Each of these structures behave very differently, and each comes with its own set of trade-offs between risk, return, cost, and flexibility. On top of that, many annuities include optional features called riders. These can change how the annuity functions. For example, income riders are designed to provide a guaranteed income stream in retirement. Death benefit riders are intended to pass a specified amount onto your beneficiaries, and long-term care or enhanced benefit riders, which may allow early access to funds under certain health conditions. These features can be valuable in the right situation, but they also add cost and complexity, and unfortunately, they are often misunderstood. One of the biggest areas of confusion is how guaranteed growth is presented and understood by the purchaser. You may hear terms like guaranteed growth or guaranteed income. In some instances, that is true, but in other cases, the guarantee applies to an income benefit calculation, not the actual cash value of the account. So while the income stream may be structured, the underlying value may not grow the way people expected. Understanding that distinction is critical. I also frequently see situations where a large portion of someone's net worth is placed into annuities. And while it may feel like protection, it introduces a different type of risk. Liquidity risk. Many annuities come with surrender periods or restrictions that limit access to your funds. Industry guidelines often suggest limiting annuity exposure to a portion of overall net worth, and in my practice, I typically stay well below that range unless the plan clearly supports it. But I've seen situations where over 60% or more was tied up in these policies. I understand when people want stability, but don't underestimate the need for access and flexibility when it comes to your financial planning. Because while some annuity structures, particularly fixed or indexed annuities, are designed to reduce market exposure, that stability can come at the cost of growth. And if over time returns don't keep up with inflation, purchasing power can still decline. So even when the value doesn't go down, risk still exists, it just looks different. Now, with all of that being said, there are situations where annuities can be used effectively, but they should never be purchased in isolation. They should be designed and implemented inside of a comprehensive financial plan. So if the plan is centered around retirement, the annuity should serve a clear purpose within that structure. For example, helping to create predictable lifetime income that complements other income sources. In other cases, they may be used to provide tax deferral for non-qualified assets or support specific long-term planning goals. The key is alignment. Not every investor needs an annuity, and not every portfolio benefits from one. Because at the end of the day, financial planning isn't about finding products, it's about building a strategy, and every tool inside that strategy should have a clear purpose. Today we broke down information in a way that most people just don't. We looked at the natural rhythm of the market and why volatility is often part of the process, not the problem. We stepped back and looked at the economy through history and saw that not every slowdown turns into a crisis. And we brought it all back to strategy, understanding how tools like annuities should be used with intention, not in isolation. When you understand the baseline and you recognize the patterns, you stop reacting to every shift and you start moving with structure. If this helped bring more clarity to what you're seeing in the news, make sure you subscribe to the channel so you don't miss future episodes of Pointe Perspective, where we continue breaking down the markets, the economy, and the thinking behind strategic financial planning. And if you have questions about your own financial situation, you can always reach out using the contact information below. I hope this discussion added some useful perspective. Until next week, take care.